morning. Good morning. I echoed, so let me turn that volume down. How is everybody today? Get my goodies up and running here for you. All right. Wipe the last bit of sleep out of my eyeballs. Morning, Thato. Good morning. Good morning. It is Thursday morning, 6:30 a.m., January 22nd, here in the States. And we got a couple days left before the weekend. And just a little bit of a recap of yesterday. So President Trump did meet in Davos, Switzerland, for the World Economic Forum, or the WEF, as they call it. And quite a bit of movement in the markets, quite a bit of reaction from his speech. He spoke for about an hour and a half. I watched most of it. And then he met with NATO's head person over there, Mark Rutte, I think is his name. And anyway, how about that? We're 2 minutes in and it's already acted up on me once. So anyway, yeah, he was talking about the 10% up to 25% tariffs on the Eurozone, and he spoke with NATO, Mark Rutte, and it sounds like he's going to not do that after all. So this is why people talk about the taco trades, meaning he threatens something really big as part of his negotiating style, and then they kind of meet halfway so that the end result isn't as crazy as everybody thinks it's going to be, right? So the taco trades. So that was one of the main things that came out of that little side meeting afterwards. And then they did apparently come up with a framework on the Greenland deal. So that's off and running. And then as we speak, I do believe he's speaking with Zelensky, President Zelensky of Ukraine. I was just looking at that right before I hopped on the live. Where was that at? Where was that article at? Let's see here, because I know that came out on Financial Juice just a little bit ago, somewhere here. But either way, yeah, pretty busy over there. So what has the results been in the markets thus far? Well, let's take a look at the charts, and we'll get a little bit of an idea of kind of a top-down analysis here. As always, I like to go to a day chart and go up, check out the VIX. Okay, the volatility index for one was pretty elevated when he started talking. So this is where the chicken started, right? The taco-ness started back on Monday, Tuesday, when he started threatening those tariffs. The volatility spiked up into the 20s very briefly, but then after his speech, or during his speech rather, it started going back down to the 16 area, okay, as far as your volatility index. So this just basically means a little more calmness, a little more comfort. Up here, when everybody's fearing about the tariffs again, that's when the volatility really started to spike, right? So obviously his words move markets, guys. Again, love him or hate him, doesn't matter. All that matters is are we on the right side of the money when it comes to the markets, and regardless of the asset you're trading, right? So anyway, his words calmed the market. Okay, brought the VIX back down. The Dixie kind of had a slight gain afterwards. That's this middle bar here. We're on a new bar today in the red, but when it comes to the Dixie, kind of a while back ago, it kind of bounced into this major demand zone area here a couple of times before ultimately pushing up. And it pushed up through this supply zone here, which wasn't a surprise because it's out in the middle, right? This is the middle of the curve. We always say don't diddle in the middle. Okay, that's why I wasn't, that's why I wasn't too worried about this zone getting broken through. Okay, we talked about this. I talked about this a couple of weeks ago before we even entered it. Like, hey, we could get some type of reaction, which we did. Get a little bit of reaction, but ultimately it pushed through it. before retracing down because of the threats, right? The tariff threats. So with the markets kind of calming down, the VIX calming down as a result of his speech, I could see this thing very easily on the Dixie potentially flying back up to the higher time frame supply zone, which is clear up here. Okay, this is a daily supply. Plus, it's at the origin of this very strong move down. So we'll see. I mean, I'm no psychic. I'm no Nostradamus. But if I had to put my money on it, I would think that we could get a push up on the Dixie, on the dollar. Same thing on the stock markets. Okay, the indices, the stock indices. Same thing happened. Okay, we had a big push up. In fact, a lot of these stock indexes created bullish engulfing candles. Okay, if we're looking at daily and 4-hour time frames, but mainly daily. I mean, look at this one here. Let's turn the drawings off for just a second. This is the S&P. Bullish engulfing candle on increasing volume. Okay. So if we've got bullish engulfing on increasing volume, then that's a pretty decent sign that we could continue to go up on the Dixie. Now, I don't have any bets on the indices at the moment because the only one on the Edge Finder is the Russell 2000 at the moment. Okay. Now, this is obviously a very dynamic list. It could change in 5 minutes, right? But as we speak at the moment, we don't have any 5 or higher on the indices. So I'm going to refresh that just to see if anything's changed. I'll be refreshing this quite a bit throughout the day because of that, just to see what it does. See what changes. See if anything changes. So yeah, still just the Russell and the China 50. China liked it. And because China liked it, and because China's markets are doing okay, Australia and New Zealand actually liked it. Okay, remember, Australia for sure is one of the biggest partners, if not the biggest partner of China. And we know that the Aussie liked the news because if we go to the Aussie index, okay, the Australian dollar index, we had a pretty nice gap up on the Aussie. Right, so Aussie liked it. I know the New Zealand stock index. The New Zealand dollar currency index liked it as well. Had a really nice gap up on the New Zealand, on the ZXY, okay, the ZXY. So the ZXY, the AXY for those two countries, they liked the speech. Yeah, you can see it in a chart. The British pound, a little more muted, but it did have a slight increase. It's good. It's a great idea for you guys that trade currencies. It's a great idea to have the currency indexes or indices, however you want to call it, on your trading view chart or whatever chart that you use. It really is a good idea because I love this. I like this so that I can put it on a daily time frame and just go through the currency, the various ones and see, hey, are we near a major supply or demand zone on a daily time frame? So there's your British pound. Here's your Canada dollar. It had a slight lift from the speech. Obviously, the dollar, a slight one, and kind of closing on the north of the 50% line of the previous day's candle. And remember, those two candles had some pretty good wicks underneath, which is a sign of rejection from the buyers overpowering the sellers, demand exceeding supply. The Eurozone had a nice gap up as well from the speech. The Japanese currency index is it's just been doing it, and it's free fall, guys. We've been talking about intervention for a while. Okay, this is your Japanese currency index, and you can see how weak it is. Okay, again, it's back down to these levels, which on the dollar yen is about the same as 160. The 160 area. So you just flip it upside down since we're isolating the Japanese yen itself, the Japanese yen currency index. And you can see why, because we're at these all-time bottoms. Okay. So that's the yen, and it didn't budge. The good news did not budge the yen. What about the Swissy? Okay. Gap up. So it liked it initially. Now it's starting to give back a little bit of its gains. Yeah, guys, for the most part, the currency indexes enjoyed the news. Okay. And then we go back over to the U.S. indices themselves. Bullish engulfing candle on the S&P 500 for a daily chart with increasing volume. NASDAQ, okay, we had a bullish engulfing candle here as well with pretty decent VSA volume. Use yields, yeah. Yeah, no, that's good. I've got the yields down here. I kind of peek at them from time to time. Okay. What did the yields like? What did the yields think? Okay, the yields didn't really didn't get too much bullish positivity. The 5-year looked like it did. Well, actually, no, I guess it would have been so Wednesday. Yeah, so yeah, the bonds kind of went the other way, right? I mean, the 5-year, there's your 5-year went down, 10-year, 20-year, 30-year. Yeah, so bonds really kind of did the opposite, right? The indices themselves, the stocks themselves, the currency indices themselves, they all went north while the bonds went the opposite way. It sounds about right. Back to the NASDAQ. So bullish engulfing candle. There's your Dow. With all these currency, I mean, all these stock indexes had bullish engulfing candles with volume. Okay, the Russell 2000, it never even made a low. Okay, because it's been pretty strong to begin with. The Russell. So it didn't even go down and test the previous day's lows, did it? Like the main three did. S&P bullish, and I mean that's a very strong signal, potential signal for the indices to keep going up, right? The Japanese yen, which is one that I've been looking for an entrance on, which I've missed. I didn't get priced down to the zone that I wanted. Remember, I was looking for, because the Nikkei is on the bullish setups, the top setups, but again, it missed my 4-hour demand zone, and I kind of drew out this disjoint channel pattern. Basically, the the expansion lines that I was hoping that it would follow. Meaning, I was when prices was in this area here when we bounced. I was looking for one more drop down to the extreme of that, which would have been in the demand zone, and I just never got it. It just got too strong. Okay, talking about the megaphone pattern. If any of you guys remember Coach James from our live streams at All Prime, and Richard as well, right? Remember, they talked about the megaphone pattern, the expanding range. Basically, you get your consolidation, and then from here, the banks like to test out the liquidity on either side. Well, it kind of made that pattern for a short while there, and then down here, and then up here. But it just got so strong, it never made a retracement to test this liquidity down here and the unfilled orders from the demand zone I was seeking, right? So it just ran off and left me. No big deal. We just, hey, we don't chase, we replace, right? The whole idea is to not be buying it, not be chasing it after price has made the move. Theta, that's called, I'll show you here in a second. It's called the disjoint channel indicator. Are you I assume you're referring to these lines, right? So if you go up here on your, if you have trading view, you just click on this line tool and you go down here to this one right here, disjoint channel. Okay, just click on that. And then the idea is, let me see if I can find a good example for you. Let me see if I can go back in time and find one. Well, I'd have to search, but basically the idea is, if I just go find a new spot to play with over here. So when you select it, I mean, let's use this as an example. Actually, let's just pretend like you have a consolidation here. Okay, and it doesn't matter the time frame, by the way, but you just have a consolidation of candles in here, right? And let's just say you start, so this is equilibrium. This is where buyers and sellers are relatively agreeing on price. Well, at some point, and this is what the banks are watching, they want to see which side of the box price is going to go out of. So let's just say, as an example, they, they finally push price to the bottom. Well, when they push price to the bottom like this is really the first signs. When the banks want to manipulate price and move it around and create a bunch of havoc, a bunch of chaos. They want to get buyers and sellers completely fooled so that there's liquidity on both sides of this box. Whenever price breaks that box, well, that's where the banks will step in and push price back the other way. Now, when they push price the other way, they want to test the liquidity. In other words, the stop losses and the buy orders, the buy stops, okay? Buy stops, market orders on this side. So what will happen is price will come to the upside here, collect, and then the banks will do the same thing. They'll take those buyers that are buying this breakout and they'll use those buy orders to fill their sell orders to go back the other way. And the same thing repeats. Now they want to test the liquidity under this area here. So they're going to go just a little bit lower. Okay? Again, what happens? There's shorts, there's breakout traders down here from market orders, okay, market short orders when this price breaks, sell stop orders as well, okay, that are triggered. And so what do the banks do? Now they know that there's going to be those sellers here. They take the other side of that. They push price back up, and the process continues. Now they're going to do the same thing here. Same thing here and test this liquidity, right? And then who knows? They may do this several times. They may do it just one time. It may go from here. Or they may just continue to manipulate price, okay, until ultimately price goes up or whatever the case is. But the whole idea behind this is you get your disjoint tool and you just put it at the top of the contraction box and you just throw it out all the way out here. Click again, and then it'll kind of go down like this for you. So the idea is, again, for me, the idea is this. If I start to see the early signs of this pattern kind of playing out, then I like when price eventually comes down to a demand zone. Because when I see liquidity being manipulated on both sides as it raises and as it goes lower down here, as it goes higher up here, I know eventually the goal of the banks is to trend that market, meaning get out of this and just keep going, right? So I always make my bets. I always make my bets on going long or going short when the extreme edge of this drops into a demand zone, or if it goes up into a supply zone. Okay, here's a supply zone. Let's just pretend like that's a supply zone. Meaning we got a, equilibrium, temporary equilibrium before price dropped, or over here, temporary equilibrium before price increased. So for me, I just like to see that pattern kind of form in between my supply and demand zones, kind of out in the middle somewhere, so that eventually it'll drop in, and then I will make my bet on this is where it ends. This is where the manipulation ends, because the banks finally manipulated their way down to this zone, whether it's the supply zone or the down, or the demand zone. Just depends on the context. Hey, where's the fundamentals going? Where's the sentiment going? Are we in an uptrend or a downtrend? But this is just kind of their way to manipulate buyers and sellers to create the liquidity for them to take, along with unfilled orders, to take the price in the direction they want to go. Now, some people will, that's one method, but also you guys will see me periodically showing a double bottom if I'm trying to buy a demand zone. Okay, if I get that double bottom right there, then again, there's liquidity under here. Okay, these buyers put their stop losses down here, which is sell orders. The banks need the sell orders to add to their fuel for their buy orders, and then ultimately drop into demand. So in this example, we've got a double bottom which is going to have stop losses below it, which is going to be sell orders, right? So if I'm a bank, I see this, I think, oh, I get to collect sell orders so I can start layering my order in. And then ultimately, finish the order in the demand zone itself to push price up. And it goes back to what, I try to talk about now and then, meaning the banks, they cannot just put in a market order or a limit order down here with their full position, because if they do, they're going to get horrible slippage. This is where order book starts coming in, right? If they've got 2,000 contracts that they want to get in, just as an example, but the ask aisle, the ask side only has 500 for the next few price points, well, price is going to keep going higher on them to fulfill the order. So they have to trick the system. They can't put in their whole 2,000 orders. They might have to put in 100. And at some point, they're going to get price rolling over. And, as price is coming down, when price does come down, the ask aisle, the order book aisle, or the level 2 data, as a lot of people call it, as price is dropping, that's where the ask is starting to increase orders for shorts, because people like to follow trends. So it just kind of creates that liquidity and increases short limit orders. Remember, an order book, a level 2 or order book is limit orders. So the banks need to create the market order liquidity to move price, to manipulate price to their liking, so that they can ultimately take the other side of it. So you got your double bottom idea here. Banks, again, collect the liquidity and ultimately take advantage of the unfilled orders from a demand zone to go long. But just to recap, the disjoint channel, or the megaphone pattern, or I call it the master pattern, is basically what it is. Okay, you get your consolidation. Price at some point will leave that box. You just never know which side. And in this example, it drops here. The banks push price to the other side and test liquidity on the other side. And then the same process repeats. And each time they're creating liquidity, because every time price breaks the structure, it triggers those sell stop orders, those buy stop orders, regardless of which, depending on which side of this box that they're on. And they just keep manipulating until they ultimately drop price into a zone that they like. And in each case, remember, they're placing a little bit. This is the banks now. The banks are placing a little bit of their order here. If their ultimate goal is to take this long, then they're going to be putting a little bit of their entry here. Okay. Now, as price comes down, they're going to put a little bit more of their entry in here. Remember, the banks are the ones that move price. You and me on our laptops, on our smartphones, on our trading computers, we don't have the power to do that. The banks do, because they're trading high, large, gigantic orders, right? So this is what the banks doing. They're layering in their order. They're accumulating their inventory. Okay, Wyckoff theory 101, accumulation. So buys here, and then ultimately down here, they're buying and taking advantage of the liquidity of the unfilled orders from the demand zone, which they themselves created. This is their blueprint. The supply and demand zones that I like to trade, that I like to buy and sell in, that's not from retail traders. That's from banks, hedge funds, multi-billion dollar organizations. They created those supply and demand zones. The banks did. So they got in part of their order. Just think about it. They got in part of their order back here. They got part of their order in. Price moves away. Okay. When price is up here, they don't want to buy up here, because they're getting a horrible price. Okay. When you're talking $1 million orders or whatever they do, would you rather buy up here, or would you rather buy down here? Right. I mean, it's just like us. We want to buy low and sell high. They do too. Big banks and institutions want to buy low and sell high as well. They just have to mess around with the system in order to get price to do what they want. So they put in part of their order back here. We know that because of the strong move away from the zone. Okay, the big strong push away. The expanded range candle, the volume spread analysis. Okay, they're the ones doing these candles down here. The VSA guys. I know. Remember, we don't have centralized volume in currency trading. Now, this isn't a currency I'm looking at, but I'm just saying in general for currency trading, we don't have centralized volume, but we do have a way to play around with their tick volume, meaning how much activity occurred in that price, in that candle. So when we get those zones created, and then the exit candle, the push away candle, the leg out, okay, when that has a lot of volume, you know that's a bank doing that. And fair value gap, right? Remember, we got to have that inefficiency. They have to create an inefficiency in the market. And it's real easy for a bank to do because they can place bigger orders than you and I can. So we want to see we want to see the fair value gap. Sorry, I'm trying to get my words out today. We all want to see that fair value gap exiting the zone, whether it's demand or supply, doesn't matter. So yeah, that's kind of a long tangent on that, but that's the basic idea, guys. They have to layer in their order. So they buy part of it here, they buy part of it here, and they buy part of it here. Ultimately taking advantage of our retail liquidity as well as the unfilled orders from the zones that they created, the supply and demand zones. So hope that little breakdown makes sense, but that's your megaphone pattern. Okay, I'll leave that example up there in case we want to reference it at some point. But yeah, having said all that, what am I looking at today? Well, guys, I did close out my trade on my Aussie Swiss. So I had an Aussie Swiss long position. I guess I could show it here. Oh, no, I don't have it on this account. Gosh dang it. Yeah, when it comes to TradeLocker, see, I've got 3 separate accounts for TradeLocker. I've got 2 different prop firms on there, and then I've got a test account. I have my test account on here, but I didn't actually get I didn't get the order for my Aussie Swiss placed on my demo account, unfortunately. And I don't think I have a way to show. Yeah, I'll just have to show it on here again. So Aussie Swiss, guys, just a quick recap of this from yesterday. Aussie Swiss. So remember, for me, I bought from this 4-hour demand zone here. This 4-hour was inside of the daily. I got into the trade here, and as you can see, that's where this is where the banks started putting in a lot of orders. I know that because of the volume spread analysis, right? VSA candles, expanded range candles, compared to the candles prior to it, right? Turn off my heater. So I ended up getting into this trade where that yellow line is. I just moved that, put that yellow line there. That's where I got into the trade. Well, I'll be honest with you. I got out way too dang early. And that's just a common theme, guys. You're always trying to lock in some profits, but you also don't want to give away all your profits, right? Your unrealized profits. So I ended up exiting that trade. So in other words, I trailed my stop all the way. My stop loss started down here. Just another quick recap on trailing stops. Okay, got into the trade here, and then once price got a 1-to-1, then I moved my stop loss just above break even. Okay, this way I've taken the risk off the trade. I've done that after price has gotten back up in this area, right? Remember, the real simple way of doing that is just measuring your entry to your to the opposite end of your zone, 16 pips, and then just measuring up here, making sure you've got at least 16 pips. So yeah, basically right in this area is where I achieved that 1-to-1. So 1 unit beyond the entry. And it's just basically a measurement from the entry to the supply zone, or to the entry to the stop loss. I need to have some more caffeine, guys. I can't get my words out this morning. All right, let's go. So anyway, guys, that took the risk off, and then from here, it's just a game of trail stopping. So we broke this price here. We moved another unit of reward. So I wanted to make sure I'd go below this structure, okay, this swing low. So I ultimately moved my stop loss here. And then when price kept going, when price was up in this area here, I felt pretty good about getting a little bit tight on the stop loss. Well, I ended up getting just a little bit too tight. Okay. In fact, if I go down to a 5-minute, that's actually where I was looking at this. So on a 5-minute chart, I was looking at this. I was looking at this 5-minute demand. I'll be honest. In hindsight, guys, I really just did this way too tight because I looked at this 5-minute demand zone and thought, it'll hold. So that's exactly where I moved my stop loss to, my trailing stop under this zone. Now, in hindsight, I should have put it under this swing low here and I'd still be in the trade, but I didn't. I didn't give enough breathing room, guys. I didn't give it enough wiggle room. And as you can see, this is where I got stopped out on the trailing stop. And then what happened after? It just kept going and going. Okay. It just kept going and going. So yeah, way too strict. I was way too damn strict on this thing. I should very easily still be in this trade, but I'm not. And I'm looking for a new thing to trade. So yeah, just to kind of recap that, if I could do it all over again, which I can't, I would have trailed my stop here. And then ultimately, when we broke this price structure here, okay, right here, then that's where I would just make sure I'm hugging the underside of this zone. And then you see price rejects, comes down. And once price pushes above this swing high, then that's where you would want to move under that swing low. Okay, when this candle forms and closes, right? So where do we set now? Well, this is back to a 15-minute time frame just to show. The obvious answer is when we break this structure here, okay, excuse me, when that structure there gets broken, when this leg here moves up and closes above, then that's obviously where you would want to move your stop loss below the swing low again. Okay. So that's just kind of how trailing stops work. Everybody has their own risk tolerance. There's no right or wrong way to do this. Some people like to close half their position and let the other half run. Some people like just a strict 3-to-1, 2-to-1, 1-to-1. Me personally, I'm a lot like Trader Nick, actually, because he does the exact same thing I do. Okay. We just like to trail our stops. Let the market tell us when to get out. I don't want to preemptively start closing profits when the damn thing could just fly up. All right. Going for the home runs. That's what he talks about. Same thing I do. Now, this structure gets me in trouble when it comes to the prop firms because I have to worry about consistency rules or equity stability score rules, things of that nature. So the runners actually kind of skew that risk or that ratio, which is annoying. I got to be honest. That's the one thing I hate about prop firms is how they do not allow you to let your runners run because of them stupid ass consistency scores. Okay. Consistency rules. If you guys have done prop accounts, so you'll know exactly what I'm talking about. Now, every prop firm is different. Some are pretty generous, 40 and 50%. Some, especially when you have a instant funded account, it's only 15%. So what that basically means is your largest profit, your largest winning day cannot be 15% or higher of your total profits. So you start having to do math equations and all this crap. It's annoying as hell, I got to say. It's nice to have the capital from these, from prop firms, but man, the rules, they can really annoy you at times. And some of them, a lot of these prop firms can detract you from your trading rules. So in other words, that forces you, when you have a low consistency score rule, it forces you to cut winners early, and you can't really let runners run. So anyway, I didn't mean to get off on a side tangent on that. but it can get annoying is the basic idea. So nothing left to say about Aussie Swiss except see if there's a possible way of rejoining this trend, right? So at this point, obviously where I bought and made my little bit of money, I mean, that's turned into a pretty nice impulse leg because we've broken all these structures and supply zones at the top, right? Supply zone that started way back here. So I have an alert set on here. Let me turn my, let's go down to 1 hour. Yeah. So at this point, I'm just kind of keeping an eye on this spot here. Now it's pretty high on this curve, but I like the fact that it broke these structures and it broke the rest of the supply. So I just want to see what happens if and when price does return down to this candle right here. Because if you look all the way down at the bottom to the left, or excuse me, to the right, that leg out candle, that's where your volume started to really increase. Now, it wasn't like it was gigantic or ultra high volume like these yellow candles back here, but that is where it caught a bid, right? So I'm just going to keep an eye on this. I will likely ignore that because I think that the best part of that move has already taken place, clearly. So if we get a really strong bullish engulfing candle in there, if we get a candle with a wick on the bottom, if the VSA candles get really strong after price wicks in, and breaks a structure on a smaller time frame, then that's where I would be okay with a potential for a second position out of this. If I don't get any of that, if it doesn't abide by my strict rules that I set on these zones, then I'll wait for a retracement all the way to the bottom, all the way to the, down here somewhere. Probably this candle right here. Because this candle formed on its own with a pretty good volume spike after it. Okay. Talking about this yellow candle down here. So this would be another likely candidate for a potential buy. That candle right there, that 4-hour candle. Obviously, this one up here is your 38.2 retracement for you retracement traders. But really the only reason I would halfway entertain this one high up is because it was a former resistance point. Okay. And supply zone. Right. So that's the only reason I'm watching. Again, I'm gonna be looking at this one with a strict set of rules up here. Bullish engulfing, volume spike, strong. Yeah, that's basically it. Bullish engulfing with a volume spike. Break a structure on a 5-minute time frame, 10-minute time frame. If not, this is the one I'm ultimately interested in. This one down here is the origin of the strong move, but keep this in mind. Did it form on its own? Or did it form as a result of bouncing into a previous zone? Well, it's the latter. Okay, it was created from this demand zone. But this area was created on its own because there's no demand zone or supply zone to the left. No demand zone, rather. In fact, you had a supply zone, and it was strong enough to blow through it. So in other words, this demand zone created itself. So this is where the big banks and the big boys and girls, right, on Wall Street, hedge funds, all that, this is where they took it upon themselves to create that push out without influence from a zone, a demand zone, okay? Supply zone's a different story because it actually broke through this supply zone, this green candle, this consolidation right here. Right? That was a supply zone at one time. And if you guys remember yesterday, this is what I was talking about. If this trade that I got in ultimately works out, it'll be because it was able to break through this supply zone. And that's exactly what happened. And again, we already went through the example, but I trailed my stop too close and ultimately got out with profit. I made $750 on one account and I think like 300 on the other. Okay. So it was $1,000 day. But it should very easily have been a $2,000 day if I'd have just stayed in it, okay? If I wouldn't have jumped the gun. If I would have just trusted the fact that I picked a good zone and I just need to let it work itself out. So anyway, so that would be the potential play. But I don't like setting too many alerts on one asset. So if price comes down, I'll see what happens here. If I don't like the setup, then I'll set my alert just ahead of this demand zone down here. Okay, so that's Aussie Swiss. Aussie Swiss, again, is giving us that nice very bullish 9 score. So this makes it even more annoying that I got out too soon because it went from bullish to very bullish. Well, New Zealand Swiss has the same. It's got a plus 10. Let's go look at New Zealand Swiss. New Zealand Swiss. And by the way, before I go any, just double check my economic calendar over here. Okay, 7:30. So here in about 19 minutes, we do have the dollar's GDP, which is coming out. It looks like they're forecasting it to remain the same. Unemployment claims, okay, our weekly unemployment looks like it's going to be a little bit more elevated potentially. Now, remember last week was the first time in a month or so, month and a half, it was the first time that it dropped below 200,000. So now we're projected to go back just slightly above it. So yeah, we'll see how that turns out here in a few minutes. Later on today, we also have the core PCE. That's the Fed's favorite gauge, as always, guys. Fed's favorite gauge of monitoring inflation. Okay, personal consumption expenditure. Looks like the forecast is 0.2%. Let me look at the previous number on this. Okay, so this December reading. So that's the same as the December reading. So PCE is forecast to remain the same at 0.2. Later on today, the Kiwi does have its inflation reading come out for the quarter-over-quarter number, where it's projected to go 0.5% down. That's quite the decline, from 1% down to 0.5%. So if you get something, if that comes out like that, we could very easily see a little bit of negativity in the Kiwi, right? Let's go take a look at recent numbers on this thing. I mean, it's, it was pretty elevated way back here in October, middle 2022, had a pretty steep decline. And now it looks like, it's trying to have a couple higher candles. These are all what, quarterly numbers, right? But this one is projected to come back to here, right here at 0.5%. So that's your CPI number. We'll get that at 3:45 my time here in Kansas City, 3:45 p.m. Central Standard Time. And then later, well, at some point, guys, Japanese yen, they're going to have their rate statement come out. So it's a big day for Japan. But as always, they always put tentative in for their times. They don't let us know the times because they're so secretive. But it's usually late in my day, very late in the evening, pretty close to midnight. So that's the economic calendar for the day. Taking a look at the dollar. So again, this is their GDP. This is our GDP and unemployment. Let's take a look at last times. Take a look at the last period here. GDP. Okay, I got to go to my heat maps for that. US dollar. GDP, the last time we had that report come out was a really nice one, guys. Okay, end of December, a whole 1% increase from the forecast, 0.5% increase from the actual previous number. So we had a very strong number. So in order for that to stay the same, we need to have another bullish number. Otherwise, if this goes down to neutral, in other words, if it meets forecast, or obviously misses forecast, then we'll see a decline in the percentage down here. And then unemployment claims, if this number comes out to be the 207, 208, like it said, then this number will go from bullish to bearish on the jobless claims, right? So we could potentially see, if all fares well from the forecast, we could potentially see the currency drop, maybe go back below the 50%, back into the 40s, right? So that's a very strong possibility for the currency, or for the Dixie, for the dollar as an individual currency. So we'll see how that goes. But as at the moment, if we're talking solely the US dollar, well, and if that's the case, it would definitely boost the New Zealand dollar top setups that we've got on the Edge Finder in the top setups. Because at the moment, it's giving us a bullish 6, right? So that means sell the dollar, buy the New Zealand dollar. Sell the US dollar, rather, buy the New Zealand dollar. So if those numbers come out, then this could likely change from a 6 to a 7 or an 8. Let's go look at New Zealand dollar, see if we can preemptively take a look at a potential trade over here. Yeah, so New Zealand dollar, guys, it's pretty expensive at the moment. I do need a discount. I don't think we'll get it in the time frame that I'm looking at. So this is our 4-hour chart on Kiwi dollar. Okay, obviously former resistance point back here. We're kind of breaking through. I had the curve analysis drawn up, but as you can see, it's just moving. So we're expensive, basically. Say down here's our discount zone, but that's a long ways away. That's 100 pips away, right? So it's a long ways away. But regardless of what the US dollar numbers come out to be, clearly, obviously, if we get a big decline, guys, this is going to be my favorite place to enter. That's a really good discount. Now, the reality of that happening, who knows? Who knows how, who knows if that's going to happen or not. But I got a really nice daily and a 4-hour confluence for demand zones waiting all the way down here at the bottom of the curve, the discount zone, right? And that's on the higher time frames. I don't know that I'd want to be looking at anything on a lower time frame because of those reports coming out. And yeah, I really don't, guys. You can look, if we're looking at a 1-hour chart, then obviously this would be your swing low down here, swing high. You could drop it down to a 15. Okay, that looks really nice. This looks like a really nice demand zone now that I see it. I can't use a 1-hour. I can't draw it up on a 1-hour because this wick touched the wick of the candle, right? So I can't use that as a 1-hour time frame. Drop to a 30. 30 is a different story. Okay. This one's giving me a gap, is it not? Now I would use the bottom here. I would kind of include the bottom on that. So there's a 30-minute demand zone, okay, smaller time frame. There's a little more noise, though. You got to remember that. There's more noise on the smaller time frames. But supply and demand works the same in every single time frame. It really does. Hell, you could go down to I don't know about 1 second. you can go down to 15 and 30-second charts, and it seems to work pretty decent. But I don't like to go down that low. It's too noisy. You start getting all the manipulation from the algos and high-frequency trading discs. I like trading on time frames that human beings are pulling the trigger, not so much on the microscopic time frames, because that's where the algos are playing. We can't think that quick, right? Computers can. So I'll let the computers trade their time frames. I prefer trading against human beings that have a pulse, that cut when you bleed them, right? Not you cut them and brake fluid comes out. So 30 minutes, there's my 30-minute demand zone. And then I could just go down the time frames here and you'll see that there's a gap there as well. Okay, 10-minute, we got a gap there as well. But in all these cases, look how strong that volume spread analysis candle is exiting. So in other words, the leg out candle, right? Big red candle, ultra high volume, breaks the structure on some of these smaller time frames, and then continuation. I got to admit, now that I look at this on a smaller time frame, if Kiwi dollar comes back to this zone, look at that, even on a 5-minute. So we went through all the time frames, 5-minute, 15, 10, 30, okay, the smaller time frames, and we had pretty strong gaps coming out of it, fair value gaps, right? This is what shows how powerful it was when demand exceeded supply. When you get these big gaps, these inefficiencies in the market. Okay, as always, the banks like to tackle inefficiencies because there's typically liquidity on the other side in the form of stop losses and unfilled orders, right? So I got to admit, I kind of like that. So I may play around on the smaller time frames on this particular asset, knowing full well, right, that if I go to the higher time frames, it's high on the curve. It's pricey. But on a lower time frame, that's actually relatively cheap. So I'm going to take a potential stab at this. I'm going to put my alert right here, just ahead of the proximal line of the demand zone. We'll just throw that out through the end of the week. as always, guys, I put my alerts on typically for just a week at a time. I let them expire on Fridays, except for Bitcoin and Ethereum. I'll keep those open through Sunday. But Sundays, well, sometimes Saturdays, but usually Sundays, I'll go through, delete all my old alerts, and just completely go into the next week with a fresh perspective, right? As far as putting on new alerts. And obviously, it all starts with the top setups on the Edge Finder. But that way I don't have anything just lingering on there forever. And because I have 100 alerts, so I don't want to be putting on a whole bunch and then running out of alerts. Okay, with my package, my premium package I have. So yeah, just a recap, recap of this potential play. Drop into demand, take it to the top. That'd be the potential play right there. That would be the potential play. And then the yellow line, okay, that represents the higher time frame play. So the green is the intraday play, the day trader play, and then the yellow is the swing trader play. If that makes sense. Because in both time frames, I mean, it's low on the curve, okay? Obviously, 30-minute, okay, low on the curve, meaning this swing low to the swing high, it's low on the curve. So there's your Kiwi dollar play. Again, these reports coming out today will, the dollar actually. So it's coming out in 7.5 minutes. And New Zealand dollar doesn't really have a gigantic ATR, okay, average true range. So it's not like it moves that much. This is a daily chart over here. This is the ATR. So it moves 42.6 pips per day on average. Okay. Basically 40 pips. We'll just call it 40 to 45 pips. So that's really not that much, right? This is one of the slower moving currencies, kind of like the euro pound, some of the Swiss pairs, okay, just kind of slower, a little on the slower side. Unlike the dollar yen that moves 120 pips a day, or the pound yen, or basically the yen pairs, right? Yen pairs move a lot, but some of these other currencies, they just don't move that much. New Zealand dollar, okay. So yeah, let me just go back to the regular chart. How you guys doing out there? Let me know if you're still around. Let me know if you are looking at anything in particular, any other assets. I got plenty of alerts here. Plenty of alerts to go through, so we can definitely do that. But if you guys have anything else, just let me know. Just throw it in the chat there. Say hello. Let me know you're live out there. I see a handful of you. All right. So yeah, we'll check back here in a few minutes whenever the U.S. data gets released. New Zealand yen. Speaking of yen, let's go take a look at that because that's pretty high on the list. What have I got over here? Okay, so this is the one that I missed out on the Sunday open because it gapped down and just missed my 4-hour zone confluence by about 2 pips and then just jolted up, guys. I'm still annoyed about missing this, but in its wake, we do have kind of a demand zone in this area here. I'm going to delete this. I was playing around with some VWAP lines, and I was taking a look, and when you're looking at this swing high over here and you wrap a anchored VWAP line there, it kind of hugged it on the way down for a while and then ultimately broke through it. It's just a dynamic support resistance, right? So, my thinking on something like this is if we can get a pretty steep decline, then by the time, the VSA moves, by the time this candle starts populating more, okay, we could be up in this area. So that'd be your VSA. Or I'm sorry, your VWAP. Excuse me. Volume weighted average price. Anytime VWAP goes through a supplier demand zone, guys, that's an extra odds enhancer and a really good sign. Okay, that just makes it more prominent, makes it a stronger zone. So I like to have the VSA spikes. That's really the main thing right there. I want to see the institutional volume taking place. But the institutions themselves use a lot of VWAP because they want to be buying at or slightly above the line. Or if it's on the other side, if it's on the underneath side, then assuming everything is a bearish sign for them or signal, they want to be selling at or just below the VWAP line, right? So VWAP's pretty strong. I don't really talk about it a whole ton, but I do like to periodically kind of dig into my bag of odds enhancers. And I was kind of doing this last night. Just kind of going through some stuff because I have it on my top. I have this on right here as my odds enhancers, other odds enhancers considered. So it just basically means these are, I think, important. I just don't use them as much because I mainly focus so much on supply and demand and then buying under fair value and selling above fair value, right? So really that's really the main things I focus on. And then, of course, I go into the volume spikes like I talked about with the VSA, RSI divergences, momentum, engulfing candles, confirmation with the breaks, the structure like I like to see. Guys, there's a lot of things to look at, and that's really the main ones. But, again, I do still pay attention to these items. They're a little further down on the list. But I'm really kind of getting a little bit more of an interest in the VWAP again, so I may end up paying more attention. I may end up moving this up top to the middle or something. But remember, things like support, resistance, bounces, I strictly use that not as an entry, but as a sign of where liquidity is going to be. Because remember, the banks are looking for liquidity. Do I want to think like a retail trader or do I want to think like a bank? I want to think like a bank. I want to ride their coattails. They're the ones making all the money. I just want a piece of it. Right? So anyway, VWAP it is. Been kind of digging in a little more, and we'll go from there. Top setups. What we got? About 2 minutes. 2 minutes before the U.S. dollar news comes out. I'm going to get that over here on my other chart. Yeah, a minute. So just under 2 minutes before the GDP number comes out and the unemployment claims number comes out. So we'll just take a quick look over here, actually. Again, looking at the Dixie. Okay, we've kind of rolled over a little bit since yesterday. The speech started on this candle right here. President Trump's speech in Davos, right? And then as the speech goes on, you can see prices just move up. And then now we're just kind of rolling over. So anyway, it's going to be interesting to see what we got. Remember, I'm keeping an eye on New Zealand dollar, but I highly doubt that it drops that much. But I'm going to put this on a 1 minute chart just to see what the Dixie does. And we'll go from there. We'll take a look at as well at we got 1 minute left before the report release. So we'll get an initial idea of the bounce, and then I'll go to the New Zealand dollar and then dollar yen because I don't want to say it's an inverse relationship at all, but the yen usually follows the dollar yen pair follows the Dixie quite snugly, I gotta say. It's not like the other currency pairs. Dollar yen is, if you're talking correlation coefficient, they're pretty similar. They're very similar. Okay, they kind of follow each other, or I should say dollar yen likes to follow. In other words, the yen likes to follow the dollar. So we'll take a look at that. We got about 10 seconds left for this report to release. 5, 4, 3, 2, 1, zeros. All right, what we got? Up. Okay. We don't have the number just yet, but the Dixie liked it initially anyway. Now, this is the noise, guys. This is why prop firms don't like you trading 5 minutes before, 5 minutes after, because you're going to start getting all kinds of crazy wicks. Now, your own cash accounts are a different story. That's obviously between you and you. But when it comes to the prop firms, the trading rules, you tend to get, especially on the higher impact ones, you tend to get a lot of volatility. Because what is it? Well, it's manipulation. It's retail traders just doing everything all at once. And the banks just kind of stand out of the way for a minute. Now, they'll move and manipulate price too. Okay, they do a lot of manipulating on these releases. Okay, so far we got the final GDP number 0.1% higher, so that's a good sign for the dollar. And then unemployment claims. Oh, okay, so we only gained 1,000 more unemployment claims compared to the last week. But more importantly, the forecast was for 209,000. It was only 200,000. So that's good. So we should see a little bit of a positive increase on the dollar. Let's take a look over here real quick. And let me just make sure that my stuff is still showing. Okay. So here you go, guys. GDP number was 0.1% higher than both the previous and the forecast. So that's a positive sign. And then again, the unemployment claims, we had slightly below 200. We had right at 200. So it was a 1,000 increase, but it was 9,000 less than the forecast. So that's why it's a bullish number. A lot of times people get confused. Well, Tiger, that's bad, right? Because it's 200,000 and last week was only 199,000. Well, yeah, it's 1,000 more, but the point is you always want to look at the most important thing is the relationship with the forecast. In other words, what do the economists think? The economists thought we were going to have a worse period. They thought we were going to have, think about that, 9,000 more people claiming unemployment. But it was only 1,000. So yes, it was an increase on the previous, but the most important relationship here is the relationship from the forecast to the actual number, from the economists to seeing if they were right or wrong. So think of the economists. Think about this. Think about the economists as your meteorologist in your local town on your 5 o'clock news. Well, think about this. Okay, right here they said, "Oh, we're gonna have a 109-degree day." I know it's 200, but I'm just dropping 100 units to make it sound like it makes sense. They forecast temperatures of 109 degrees. Nobody wants to. That's crazy. But then it comes out it's only 100 degrees. Yeah, it's still higher than the previous day, but at least it's not a death spiral. At least we're not going to melt our faces off on 109-degree temperatures. We only got 100. I'm pretty happy about that. Let's go out and have some fun without dying of heat exhaustion, dying of thirst, any of that. Now that in either case, because see, I live in Kansas. We get temperatures up here up in the 109s. Now I'm talking Fahrenheit because you guys know we're weird over here and we use the standard measurement schedule. But if I had my meteorologist telling me we're having a 109-degree day and then it's only 100, we're pretty damn happy here. But 109 degrees, we want to stay in the house with the air conditioner. So it's kind of got I know it sounds silly, but it's kind of a similar thing. Really kind of a similar thing. It goes by the difference between the forecast and the actual number. So that's a good sign for the dollar, guys. Okay, back to dollar yen. We did have that pretty good push up initially. Now that's not gigantic, but 60, so we'll call that 70 all the way up to 83. So we had a 13 pip spike up on dollar yen, and now we're retracing. So this is kind of where the megaphone pattern comes in. This is not surprising at all to see price go up, test liquidity, go down to test liquidity. We could very easily see this thing doing it some more times, guys, before ultimately the bank's, picking a direction. The cool thing about economic report releases is that, especially on the higher time frames, ultimately, when it comes to supply and demand is still going to do what supply and demand does. The only thing an economic report release does is just speeds up the process of what was going to happen anyway. I don't know if that makes sense or if I explained that all right, but in other words, the banks leave the footprints. So people always think, well, why did price, from a retail trader's perspective, why did price, we had a positive report. Why did this asset go down when it should have went up? Well, that's because that's where manipulation comes in, and oftentimes it's just to manipulate the liquidity for the banks so that they can ultimately get in the move that they want to get in. So supply and demand, I think it's still supreme over all of it. Again, oftentimes, especially on the higher time frames, the only thing these big economic releases does is just speeds up the process. If it's going to bounce into a supplier demand and go the opposite way, well, there you go. You got the release speeding up the process again, so it can do what it was going to do already. So anyway, that is your dollar yen. And we're just kind of getting that manipulation up, that manipulation down. Let's look at New Zealand dollar, because remember, this is the pair that I wanted to trade. And yeah, as I expected, it only moved at about a few pips, 3, 4, 5 pip range at the moment. So nothing doing on it. Again, ultimately, I'm waiting on this 30-minute candle down here. I just took into account the wick on the previous candle since it went a little lower. If I wanted to be exact, then there would be the 30-minute candle. But I'm just taking into account this, a little bit slower of a swing. Stop loss below. And off to the races. What else I got? Okay, so pound CAD. This is another one that I've got a short bias on. Pound CAD right here, -6. So this one hit overnight while I was asleep, guys. It hit a supply zone that I was interested in shorting. So I had this 4-hour candle right there before the leg out and decline. It went well over 3 units to the 1 unit of, the zone itself. But it ultimately had these wicks, and these wicks down here kind of had me pause. Now, yesterday when I was looking at this, okay, so this candle formed during my stream yesterday, during our stream. We had, let's see here, right in this area. So this is where price was yesterday. See, down here it was looking fine, but then ultimately it pushed up past the 50% of that previous candle. This is a 1-hour time frame with some higher expanding VSA volume, okay? And then as you see, we just kept going. Now it didn't touch, but it just basically on the higher time frame created a big ugly wick underneath. I don't want to see that. And then ultimately we came down. Now we came into the zone at 3 a.m. my time, guys. So again, I'm asleep. I'm drooling on my pillow, whatever the case is. And it's not, I didn't want to set, in other words, I don't want to set a limit order on something like this. Because if I look again at the 4-hour candles, guys, I really prefer to see the downwards pushing candle. I need to see it close, at least close to the bottom. In this case, it closed above the 50%. So that's just a bullish signal on the higher time frame. The higher time frames typically outweigh the lower time frames. So there's no way I want to put a limit order there. But in watching it, if I were watching it live, again, at 3 a.m., right? What does it look like on a smaller time frame? Let's take a look. Okay, so right there, you did have a bearish engulfing candle, but you didn't have it on higher volume. We're looking at this VSA candle right there. That was clearly the same, if not even a little less than the previous candle. So that really was not a good signal to short the market. Did we have a short? Did we have a signal? Let's take a look. Okay, so if I'm looking at a 5-minute time frame, I don't think I'm really seeing it. I mean, you could probably use this candle here because this was a bearish engulfing candle. Okay, The candle completely engulfed the previous candle. And if you look at the volume, that was oh gosh dang it. That volume candle right there, that VSA candle was bigger than the previous candle. Okay, we're talking about this candle. That was bigger than this candle. Now this is the engulfing candle to the downside. The bearish engulfing candle that swallowed this candle. So in other words, effort matched result. The result was the fact that we had an expanded range candle that engulfed the previous candle on the price chart, the candlesticks. That was the result. Now the effort was right here. The effort was clearly higher than the effort from the previous candle. So that's Wyckoff Theory 101. Effort has to match result. If effort matches result, then it's a real play. If effort does not match result, it can be a false move. Okay? But this looks like a real move because we had effort match and result. So because of that, yeah, that would have been an entry. That could have been an entry right there. Now, I personally, if I just zoom in a little bit, I personally would have preferred for this engulfing candle to kind of break this structure over here, break these wicks. But if you're aggressive, or kind of aggressive, kind of in between. I mean, this is really kind of verification, but I think it's kind of an aggressive way. I'm a picky guys. I'm a lot pickier than most people. I would have preferred that candle to break this structure for me to get involved in the trade. But nevertheless, okay, it still worked out. Okay? Again, and that's a 5-minute time frame. So that's really drilling down. What about a 15? Do we have anything on a 15? I mean, on a 15-minute time frame, one thing I do like is that you did kind of have, as far as shorting this market, okay, we did have a couple wicks. Let me zoom back in or get rid of the zoom. So we did have these wicks, these rejection wicks. Okay, remember, price was up in this area at one point, but the sellers slammed it down. In other words, the unfilled orders, the shorts, the people waiting on this price area to get hit so they can short the market. So you can clearly see rejection. So that in itself is a pretty good sign to sell. Let's go back in time to where we don't know what's happening. Okay, so there's a rejection. There's a rejection. That's a strong rejection right there because we're closing under the halfway point of that candle. Another candle, right? So this is kind of, it's always good to play the hard right edge game. Go back in time on whatever asset you're wanting to look at and just kind of project. Now, another thing. Let me do something, guys. Nah, I don't think that's a great example. So we'll ignore what I was going to say. Now I did put a new alert on here, by the way. So if I take a look now, obviously that entry was a good entry because that would have definitely paid. That would have been at least a 3-to-1. We haven't quite broken the structure. If it breaks this structure down here, then I'm actually kind of excited to see what happens if it does return again, because it did leave a new supply zone. It formed a brand new supply zone, did it not? Okay, let's just color that one this color for just a second. So it formed a new supply zone. Now, did this supply zone create itself, or was it created as a result of a previous zone, a previous supply zone? Well, the answer to that is clear. We bounced into the supply zone. So this supply zone created this supply zone. Remember, this is where I kind of go back to earlier when I said when I short in supply zones, when I buy in demand zones, I prefer that those zones are created themselves. Meaning the big banks and institutions deliberately created it in that spot, out in the open. I want zones out in the open. I don't tend to like trading zones like this where it did not create itself, where it was created as a result of another zone, right? So yeah, I did put an alert there. I do want to keep an eye on it. Again, it's just a confirmation entry. Smaller risk. If I get a bearish engulfing candle like we had on the 5-minute, okay. If I get the volume picking up, then potentially we could see another move down. Potentially it could create that, that topping action, that bottom action. In other words, a sideways trend, selling at the high end of the sideways trend, the channel, buy at the lower end. Because at this point, we kind of have a double bottom. So ultimately, if I get excited about this supply zone at all, it will only be because it closes below this swing low. So in other words, just to redraw my goodies here, I need to see price break this structure and then come back up to the supply zone for a possible short. Okay. So with not a full position of risk, and after it breaks the structure to the downside or creates a bearish engulfing candle like it did on the 5-minute chart. Again, just to kind of recap, we had that candle right there was a bearish engulfing candle because it was higher and lower and closed at the bottom and underneath this candle with volume increasing. In other words, effort matching result. In other words, a real move. Okay. Now that doesn't always mean it's immediately going to drop. You may get a handful of candles like it did. It gave you a couple more 5-minute candles before ultimately catching the ask and the shorts won out. Supply exceeded demand and price dropped. So there's your play on pound CAD. Is anybody out there? I see a few of you, but I haven't seen anybody chat with me. Let me know if you're still alive. Let me know if you guys are still alive out there, or if it's just your computers landing on your, laying on the channel, and maybe you went to sleep or something. But yeah, let me know. Let me know if you guys are trading anything. We do have about 10 minutes. Okay, about 10 minutes left, and then I'll get out of here. Let you get back to your day. So just say hi, hello, how are you? Anything. I just want to, that way I know I'm talking to somebody and not just myself. This channel is for you guys, so I try to personalize it around you guys. So any input I can get, any improvements, any recommendations that you have for me, please let me know. Okay. I love constructive criticism. If I could do something better, especially if the most important thing is if it can help you guys. If I can do something to help you guys, that's all I care about. Guys, I'm doing this for free, So by all means, let me know. Let me know if there's anything I could do. If you are listening out there, I do want you to know that I may start playing with some new times. Haven't quite figured it out. At the end of the day, I am on challenge accounts. So might be trying to figure out some new employment. Okay. Do you have to figure that out? I mean, I got a pretty decent stash, but a stash doesn't last forever, right? So when the stash runs out, got to figure something else out as far as employment. So yeah, looking for content creation. Would love to trade accounts. Man, I would love nothing more than to trade an account. But the problem with me is I don't have the economics degree. I don't have the paper. I don't have the experience of working in a firm. But what I do have is the School of Hard Knocks on my side. I do have now 12 years of study. Okay? 12 years of study on this stuff. I watched The Field of Dreams when I was a kid. Kevin Costner says, if you build it, they will come. So that was my mindset with trading. I don't know how it's ever going to work or what kind of results, what kind of opportunities I'll get. But if I build it, they will come. Meaning if I just keep studying away at this stuff and, trading the demo accounts, trading the small accounts, creating content that the right people will see it and potentially I could get, some type of opportunity. So that's why I do it. That's why I've studied. I even went through, a couple of years of hardcoreness. Pretty disheartening stuff. I still studied. Okay. I took a little bit of a break, deal with some stuff, but not long because I knew that somehow, some way this will help somebody. I mean, obviously make money to where I can pay my bills. That's really goal number one, but also how can I help people? Because I've seen people struggle. I've seen a lot of people struggle financially. So it's not a fun thing. So it's just cool to impart the wisdom and the things that I've learned, right? Just to kind of try to help people out. So this is for you guys. As always, let me know if there's anything you'd like me to do or add to or take away from, whatever the case is. Thedo says the system I've built, Euro yen, it's giving me economic score, interest rate divergence, COT report. Okay, seasonality, technicals, risk, sentiment. Thedo, do you have the Edge Finder, or is this so you just kind of came up with this on your own? This your own personal algorithm, it sounds like. That's cool though. No, that's awesome, man. That's what you just listed there is way better than what I used to do. Okay, before Edge Finder came along. Before this Edge Finder came along, guys, I was looking at the report in front of me. So today's a great example. The only thing I saw today was, if I just go to my red events, right? Unemployment and the GDP number, which I thought was the end all be all. But I forgot the previous day we had President Trump speaking, or the day before that. Well, let's just go back to last week, right? Forgetting about those unemployment claims, forgetting about the PPI that happened last Wednesday, the PPI reporting, the retail sales. So in other words, with each passing day, I just never made it a point to remember what the hell the results were from the previous day. I would only focus on the day in front of me. So what you're doing is actually way more better than obviously what I did for a big chunk of that time. But now I got the Edge Finder, got the top setups, and it calculates and it simplifies everything for me. So it's just really cool to just be able to, at a glance, whether it's your system or Edge Finder or whatever the case is, just to be able to, at a glance, go see what the strongest and weakest currencies are, or assets, indices, Bitcoin, everything. So no, that's great, man. Yeah, COT report's huge. COT report is the biggest factor in sentiment analysis, right? I mean, it's the absolute, I think, most important thing. Now you got your retail sentiment, but obviously having this COT report on here is huge. And it also kind of helps preempt ideas. Like, again, just looking at the COT report, we talked about this on Monday for the yen. Okay, the banks and institutions got rid of 28,000 longs and added 25,000 shorts. Huge change, 10% decline, 10% drop in their shorts, their net, week to week short position, right? And moved from what was a 48% short to a 58%. So in other words, it moved from net long to net short. Yen is a great example. And to me, is it a surprise that they had this big of in other words, that confirms, in my opinion, all the fears and worries about intervention. The Japanese yen getting intervened by their bank, by the Bank of Japan, right? Buying up their currency. COT is gigantic. This right here should tell everybody not to leverage up on a short on the yen. A long, I should say. So in other words, dollar yen, right? You're buying dollar strength, you're selling yen weakness. Well, if the banks want to strengthen their currency, I wouldn't want to be leveraged up in that asset on a position trade or a long-term swing trade. Okay. Especially for people that don't put in stop losses. Do you think that'd be it'd probably be pretty damn stupid for people to be along a dollar yen knowing if they knew that this was happening. But thankfully the COT report lets us know, hey, look where the bank's positioned. The banks aren't stupid. The banks are pretty smart. They are called, after all, smart money, right? So if they're declining, if they're going net short, don't you think we should maybe do the same, or at least avoid going net long, going long? that currency. So yeah, COT report, man, it's gigantic and really important for this week. Now tomorrow's Friday, so we'll get a new readout around 4 p.m., 5 p.m. my time here in the States. The only downfall to the COT report is it is always 3 days old whenever we get the data on Fridays. It's always accurate as of the Tuesday right before, so 3 days prior. That's really the only downfall, but it's still, guys, remember the banks, they're typically in longer term trades or positions, right? Now they have prop traders that are trading the same time frames I've got that I do. Yeah, I do daily 4 hour, I do 2 day to 4 day trades. But they, they make a lot of their money in the longer term stuff. Okay, the buy and hold is growing people's 401k accounts. So, and then not to mention their algorithms, right? They're high frequency trading, which is quite the chunk of their business. I just noticed. I was reading an article about it the other day. But ultimately, they're facilitating trades from retail traders, so they're making a lot on the spreads and the fees, right? So it's quite the gig they've got. What's your take on Euro Yen technicals? Let's take a look. Go look at Euro Yen. I thought for a second I had it on the list, but I know I don't. So let's go take a look at it. As always, I like to start from the high up time frame. Now, we already know the yen is weak. Okay, we know that because of the JEXI. This is your yen just going down and down and down. I don't think it's near. And we've broken this structure. We broke this structure, had a slight pullback, and now we're continuing down. So again, yen weakness. Hey, we don't have another demand zone for quite a while on the yen. So very easy. Unless the Bank of Japan intervenes, I could see this thing dropping quite a bit further. Looking at the Euro index, this is a daily time frame, so it just kind of went going sideways, but it's gotten some strength. Okay, we gapped up on Tuesday. Let's see, so this was Friday, and then this week we had a strong gap up. So the Euro is showing strength. So yeah, Euro yen definitely for a potential long. Let's go take a look at the chart itself, though. And I think on the Edge Finder, I don't think it. I don't think it gave us a setup. I know it's neutral. I just don't know if it's neutral on the bullish side or the bearish side. I think it's Euro yen. So it's neutral, but it is a +4, meaning it only needs one more piece of good Euro news or one more piece of negative yen news. And this thing will go to a 5, change to a 5 or 6, which is obviously what I need to get in a position. So real quickly, if we're looking at it, if anything, I'd be wanting to buy it. So what has happened of late? We had a demand zone on a daily. Oh, I already have it drawn up. We had this daily demand zone. Okay. Price dropped in. And oh, by the way, there was my confluence, my 4-hour confluence. So I had a 4-hour demand zone inside of the daily demand zone. That's confluence. Price came down, gapped in on Sunday into that zone. And what's happened? Okay. Demand highly exceeded supply. We know that because price moved up and now it's broken this structure. So what do we do here? Okay. We broke that structure and closed. Well, if I want to take a risk on a smaller time frame, I could probably find a demand zone in this area here. If I wanted to wait for the higher time frames, then obviously this would be closer to the, this would be at the bottom of the curve. But again, this demand zone did not create itself. It was created as a result of this demand zone. So I don't know that I'd be too excited about that. If I go to a smaller time frame, okay, then this is going to be a swing low, swing high. So we've got a little bit different look to the curve analysis. Let's go down here to the bottom of it. Let's see here. Let's go back to a 1 hour for a second. See, I can't use this as a demand zone candle because it looks, oh, well, actually, maybe it didn't touch. It's an indecision candle. Let me look here. Okay, so I guess we did miss. So that wick did not touch. So that's a good thing. So yeah, this is an active 1 hour demand zone. I mean, yeah, you could you could definitely look at it as a 4 hour as well, which would be up here. The 4 hour actually looks better because you had a stronger gap out. In other words, this is your fair value gap right here. So there's your fair value gap on a 4 hour time frame. We dropped to a 1 hour, and the fair value gap is there. It's just not as good looking. See, there's your 1 hour fair value gap. That doesn't look good at all. What about a 15? 15 looks a little different. So your fair value gap on a 15 would look like this. Okay. Because this would be your 15-minute demand zone right here. So I don't like to put a ton of rectangles on. When I go to the smaller time frames, I'll just put a white line at the top of the zone. Okay. So that would be the proximal line of this demand zone, which is this 15-minute candle. Now, what about my vol? Now, did it break any structures? Okay. It eventually broke this structure. It eventually broke this structure. What about the volume, the VSA? Volume wasn't the greatest, but it's also not disgustingly horrible either. So there's your base candle with low volume, but then your leg out candle, the volume started to grow. Okay, the VSA, the institutional activity. Okay, but it didn't really grow like I like. So yeah, I mean, you could potentially get in there at the 184, basically the 185 level, round number. But on the smaller time frames, there wasn't really that. I don't know. There wasn't really a ton of volume in there like I like to see. I like to see these candles be twice as high as previous candles. But as you can see, they didn't. In other words, so just keep that in mind. VSA, volume spread analysis, that's kind of the tick volume, if you will, on the institutional level. So I need to be seeing these candles higher up on the legs out, showing that they're actually highly involved in creating that. So if I don't see that, then that just very simply tells me that this was basically created by the retail traders. Because if it was an institution, these candles would be a lot higher up. So anyway, guys, that's your euro yen. Yeah, I think ultimately on this thing, there's probably going to be some better opportunities with yen pairs as far as like CAD yen. But yeah, that is a potential spot. This is already used up. And yeah, CAD yen would probably be my choice. I mean, if you're wanting to trade a yen pair, okay, that would be it right there. You got a little bit better of a demand zone set up over here. Now that demand zone's already been touched, but you have another one right here. And by the way, you got anchored VWAP line going right through it. So if we get a quick drop there, I really do kind of like this area. So anyway, yeah, I think that's about it for the day. Hope that helps on euro yen. I just think there's more assets out there, but I'm going to get up out of here, guys. It is 8:00 my time. I will be back tomorrow. So as always, if you can, just go and like, share, subscribe to my chart, to my goodies over here. Okay, view my chart channel at Trade Like a Tiger, the one you're on. I've already got my live stream created for tomorrow, which is Friday. Okay, episode 11 on the 23rd. So just go over here and click the notify me button if you would, just to know that, just so it can yell and scream at you when I do go live in the morning. We know how busy life is. Sometimes I'll be wanting to see somebody stream and I'll forget until it's already into it 5 or 10 or 15 minutes. So there's my channel there. Please go like, share, subscribe, all that fun stuff. And I will be back tomorrow morning and we'll cuss and discuss the economic events of today. So with that, ladies and gents, of today. With that, ladies and gents, have a wonderful day, and I'll talk to you guys and gals tomorrow.